The best to sidestep the worst of it. I knew I was going to be able to work gold and silver in here somehow, but this is a picture of the dramatic fall in purchasing power of the US dollar as measured by gold. And to quote Norm Franz, gold is the money of kings. Silver is the money of gentlemen. Barter is the money of peasants. But debt, and I need to modify his quote, debt-based national fiat currencies are the money of slaves.
The cracks in the global financial system are no longer forming. They're widening. The data is precise. From collapsing condo prices to surging commercial real estate delinquencies, the U.S. economy is flashing recessionary signals that can no longer be hidden behind manipulated statistics or temporary loan modifications. Construction activity is plunging, job losses are accelerating, and entire city centers are sitting half-empty. What's unfolding is not just a cyclical slowdown, but a structural crisis, a repeat of 2008, but on a scale that will include commercial real estate, equities, and sovereign debt. MikeMaloney, PreciousMetals expert and founder of GoldSilver.com, warns that the purchasing power of the dollar continues to evaporate as this financial reality deepens. Gold and silver, the money of kings and gentlemen, are not merely hedges. They are the escape hatch from a system built on debt and denial. With Warren Buffett's record $347 billion in cash sitting idle, even the smartest money in the world is signaling caution. When the correction hits, those holding hard assets will preserve wealth while paper promises disintegrate. Now, we present the clips from MikeMaloney's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
George Gammon at Rebel Capitalist points out this is the Conference Board's leading economic index versus the Conference Board's coincident economic index. So one of them is a prediction of what's going to happen, the blue line. The black line is what is actually happening. And what you see here is the blue line rolls over, and then sometime later, the black line rolls over and a recession starts. The blue line rolls over sometime later, the black line rolls over, bumps into a recession, and a recession starts. What I find really interesting here, the blue line predicted that there would be a lab leak in the virology lab of Wuhan, China, and causing a pandemic, causing a crash. I don't know how this sort of stopped rising and started to roll over, but then you have a coincident crash. They both crashed at the same time. But look at what has happened recently. In 2022, this peaked and rolled over, and we have this 3-year divergence going on where the coincident economic index, what's happening is this is like fake, and something is going to break, and when it breaks, there's so much of a divergence here that the correction, I believe, is going to be vicious. It's going to be one of the worst in history. This is new housing units under construction, and then all employees in the construction industry. And what you see here again is the new housing units under construction peaks, and then later the employees are discharged, and so the number of employees falls. It peaks, the employees are discharged, but this happens during a recession. The peak happens before a recession. It's a predictor, and it's worked almost every single time. Here the peak was pretty darn early, and then this falls. Now they're inverted, so you've got to look at like the peak, and then it starts to fall, and we're in the global financial crisis where new homes, the construction fell a lot. And then look at where we are today. This peaked back in, that's about late 2021, 22. It peaked in 22 and went level. And in 24, 25, it has been falling significantly. And the number of employees is just rolling over now, predicting that we should have an official recession within months. That is what that is predicting. So This is condo prices collapsed so far by city from Darth Powell. 25 bigger cities, I think this is supposed to read the 25 biggest cities with price declines. We've got California, Florida, Texas, Florida, California, Florida, Colorado, Florida, Idaho, Michigan, Texas, Washington, Louisiana, Nevada, Oregon, Colorado, Arizona, New York, Arizona, Florida, Texas. This is all over the place, but these were the biggest growth markets. So they're the ones that are where the bubbles are popping first and things are collapsing. Nightingale Associates, the two-tower Denver Energy Center sold at auction last week for 3% of its price 12 years ago. 3% of it sold for $5.3 million, and it was purchased for $176 million in 2013. In 2022, J.P. Morgan Chase Commercial Mortgage Securities Trust bought the Denver Energy Center for $88.2 million in a foreclosure auction after the owner had failed to make payments on its $102 million mortgage. The complex is just 18.2% occupied. Now, I'm going to get to this in a couple more tabs. Maybe it's the next one. I don't know. But 18.2%. Now, banks have been covering this up. People used to, after the pandemic, people started talking about all of the people working from home and how all of these commercial office buildings have this very, very low occupancy, and there was going to be this tidal wave of bankruptcies and something in the real estate sector again, but this time commercial real estate, that was going to trigger an economic crisis. Well, it turns out that what you're going to see is that the banks have been doing loan modifications and forbearance and things like that to cover up the fact, and the dam is about to burst right now. Denver now ranks as number 6 nationally for the CMBS office delinquencies at 27.2%, nearly triple the U.S. average. The CBRE, which stands for Coldwell Banker Richard Ellis Group, pegs second quarter downtown Denver vacancy at 36.8%. Let this sink in for a little bit. Commercial real estate is headed for a meltdown on a scale that we have never seen. This is going to be just like the global financial crisis of 2008, with real estate in the biggest bubble in history, bigger than then, plus commercial real estate, plus the stock markets. That didn't happen in 2008. That was residential real estate and mortgage-backed securities and derivatives meltdown. This is a far greater disaster. I want you to, this Financelot posted this video. I want you to watch this. It's important. So, banks have been hiding massive delinquencies in home loans and corporate loans since 2023. This video is actually a little bit more about commercial real estate loans. Unbelievable. So basically the fuse is lit and they've just covered it in sand so nobody can see it until it blows up. And that is true. Now, the man that a lot of people, many people, sometimes I'd say most investors consider the smartest investor on the planet, Warren Buffett, has a pile of cash at a record $347 billion. Nearly 30% of Berkshire Hathaway's assets are now in just cash and T-bills, the highest level ever. So he's sitting on the sideline knowing that something bad is coming his way, and because it's the highest cash position, he probably believes this is the worst thing that is coming his way. The best advice on the global financial crisis I heard, and so this is from Connor Sen, in 2006, 2007 was, don't try to be a hero. If you're worried, just try to avoid the blast radius. Avoid debt, housing, financials. Do the best you can. If it goes bad, it's going to hurt. Just do the best to sidestep the worst of it. And so
the economic indicators are flashing red across nearly every sector of the U.S. economy. Google searches for "help with mortgage" have surpassed levels seen during the 2008 crisis, signaling widespread financial strain among households. Building permits are rolling over. Freight activity has collapsed to its lowest levels since 2020, and late rent payments are accelerating sharply. Meanwhile, corporate debt, auto loan delinquencies, and stock market valuations have reached extremes, all while margin debt has surged beyond $1 trillion. The result is a system stretched to its limit, propped up by speculation and faith rather than fundamentals. This environment creates the perfect setup for gold and silver to assert their historical role as wealth protectors. As margin calls cascade and asset prices reset, precious metals stand apart, tangible, unleveraged, and independent of financial engineering. In past crises, gold and silver rose as confidence in paper assets collapsed, and today's distortions suggest an even larger rotation ahead. Investors who understand this pattern aren't chasing risk, they're positioning for survival. Let's get back to the interview.
Searches for help with mortgage surpassed 2008 housing crisis. So this is, we're supposed to be having this great economy according to the government. Everything's peachy according to the stock markets. And people are searching for help with their mortgage greater than they were in 2008, the global financial crisis. This is insane, and this is honest data that anybody has access to. If you search for, Google searches for "give car back" are near all-time highs, and that's from Darth Powell. So this is another one, "give car back." Then building permits have rolled over and are falling. And what you notice here, with the exception of this false flag right here, when they roll over, a recession is just behind. And here with the exception here, it's sort of, in 1998, it didn't really roll over that much. It just slid. But, it predicted the global financial crisis pretty well. But look at what's happening now. It's been rolling over since late 2021, early 2022. So we're headed for something that's probably not going to be very good. The case freight index. Now the freight index, this is very important because if we've got this booming economy and we've got this booming stock market, it means that all those companies in the stock market should be building and selling more stuff that has to be shipped to somebody. If the freight index is falling, it means that, and it dropped 9.3% year over year in August, hitting its lowest level since 2020. This is really bad news. Late rent payments continue to tick up, and late rent payments are skyrocketing from Darth Powell. And they are. Look at that trajectory here. And this is, all in 2025, this turnaround. It was falling on the average, and then suddenly, this year, it just started to take off like a rocket. So we're in some trouble. This is used cars. So this is CarMax. So this is what used car stocks are doing. Look at that plummet, and this was based on sales and earnings. The stock plummeted, so used cars are in trouble. Turning to the stock market, Swing Trader says this short will be more rewarding than the COVID crash or the global financial short. Well, I'm not shorting anything. There's a potential for some serious losses when you short or some big gains. Feel free to do whatever you want. I don't give financial advice. But look at this trend line. There's 1, 2, 3, 4 hits establishing a very, very solid trend line. And look at where we are. We're up out of the top of it, meaning that a huge crash can happen. The correction can be enormous, and we are in dangerous area. The S&P 500 versus job openings. Look at the great correlation that they had in the past. When one is going up, the other one is going up until the beginning of the end of 22, beginning of 23. So this divergence is really bad, and it's been going on for several years now. And so something is going to break, and when it does, I believe it's going to be horrific. Spencer Hakamian says, AI boom versus dot-com bubble, scary. Now, there's no time scale on here, but the time scale is here. This is 4 years, 98 to 2001. This is 23 until now, which is only 2 years, but you'll notice that the line here is not done yet. So they're probably on the same time scale. Now, I wish that he could have shifted this, made this, go up to a scale of 8,000, and then shifted this by this one notch, because what you've got here is a factor of 5, and this is also a factor of 5, and it would be great if he could have lined these two lines up so that they start at the same point, because you'll see that today's climb is much steeper than going into the NASDAQ bubble. This is insane. The great Martis says that only twice in history has the Shiller PE ratio been above 40. You are now part of history. Enjoy. Well, you can enjoy this if you're an investor in precious metals. If you're an investor in the stock market, this is coming off the highest peak in the roller coaster, and you don't know what's coming next. Current Shiller PE at 40.15. Now, this is the Case-Shiller cyclically adjusted PE ratio that he's talking about here. And he's got a mean and median at 17 or 16. However, that's if you take just like this century. It isn't even this century's data. It goes back a little bit further. But if you take this back all the way, and I have, you'll see that if you add another century of data, this fair value is somewhere around 12 to 15, not 16 to 17. That in the last century, PEs this high were considered bubble territory. Now, 40 is bubble territory, and this is considered the mean. It's totally insane. I think we're going to get back to realistic valuations like we were at in the last century. MAC 10, the last time we had Dow theory non-confirmation, global markets crashed. Got two non-confirmations here. And the first one, you're looking at the Dow Jones Industrials are in black. So these are the companies that make this stuff. The Dow Jones Transportations are in red, the companies that ship the stuff. And they were rising, and the Dow Jones hit a double top while there was a divergence, a fall in the transports. Here we have the Dow Jones just dramatically going north, and the biggest divergence in history with the transports falling while the Dow Jones are going north. Try and find something similar to this setup in this graph at all, and you can't. Now, Adam Taggart points out that margin debt is what margin debt does in a crash. When there's a sell-off and prices start to fall, anybody that is out on margin gets a margin call, and they have to either cough up a bunch of cash, put it into their account, or sell part of their position, causing further downward price pressure. When the markets fall, people that are out on margin get squeezed, causing the markets to fall further. So this accelerates a crash and makes it a lot more vicious.
The warning signs are no longer subtle. They're blaring across every corner of the financial system. Mortgage stress is back to crisis levels, rents are going unpaid, and commercial real estate is on life support. The illusion of economic strength is crumbling under the weight of soaring debt, record margin leverage, and inflated valuations detached from reality. Every metric that once predicted recession is now flashing in unison, yet the crowd continues to cheer as if this time will be different. But history reminds us, it never is. Gold and silver are once again emerging as the ultimate refuge in an era of deception and denial. While paper assets dance on borrowed time, the real stores of value remain steady, untouched by political promises or financial engineering. These metals have survived every debt bubble, currency reset, and central bank misstep in history. Gold and silver will not just protect wealth, they'll redefine it. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.